Today I will show you the charts of the S&P 500 index, the XJO. We'll mention briefly a few key sectors here, and we will follow up with two high conviction buy recommendations. So starting with the S&P 500, the first thing that we notice from the 2-year chart is how volatile and choppy the price action has been over the past 2 years. And while current levels are well above where the index was sitting 2 years ago, the structure of the price action is not inherent with a strong bull trend. There is a lot of uncertainty which is seen from the volatile swings, which shows that there is a lot of indecision among market participants. Zooming into the price action over the past year, we've seen that the rally from the February 2016 low is losing momentum, and over the past few months, the market got really quiet, and it's now trading between 21.19 and 21.93. This period of quietness, which is also combined with overbought and diverging momentum conditions, indicates that most likely the market is entering a phase of distribution similar to the distributions we've seen during 2015. While we are still in an uptrend, as the medium-term uptrend line holds, it is critical now to watch the key support and resistance levels. So key support in the near term to watch is 21.19. A break below that level will confirm that we are in a distribution and will signal few aggressive sell-offs in the very short term. But the daily chart is very noisy, it's very busy, it's all over the place. In order to put things in perspective, we really need to look at the weekly chart, which give us an idea where the long-term trend is sitting. So the 30-year chart on the S&P 500 shows that we are currently in the longest bull market seen in the US, and over the past 2 years, that bull trend that we've witnessed since 2009 is really slowing down and is getting tired. Roughly the price action is trading between 1800 and 2200, and over the past 2 years the index struggled to break above the 2140 and 2200 resistance, which in my view is very strong and is unlikely to be broken on the upside. If we do see another leg up, I think that will be just a short-term spike to around 2300, where we will see a strong resistance arising. So yesterday, Ben Simmons was saying that eventually the music comes to an end. And looking at the weekly chart, I just seen how the rhythm is slowing, and a lot of key investors already grabbed the chair and are sitting on the sideline. So moving to our market, where things are slightly different. We've seen a very strong rally since February, which is still intact. What is the area of concern is that the corrections are becoming deeper and deeper, which can be seen by the breaks of the medium-term uptrend lines, which is also a sign of indicating uncertainty in the market. Despite that, I'm a bull by nature, and as long as 51.92, which is a key support for the index, holds, I keep a positive view on the index, and I believe that 5600, potentially 57, can be reached over the medium term. Short term, we are overbought and we can see some pullbacks, but as I said, momentum indicators are constructive, and so far we don't see a reversal of the recovery from February this year. Looking at a few sectors in Australia, the one that grabs my attention is the energy sector. I've sent a piece on oil recently. I was quite bearish on oil over the past year, and my $32 downside target has been now reached. I firmly believe that oil is in the process of making a very important bottom. Also, I think a break above $52 resistance is imminent, which will confirm that a bottom is in place. I don't think oil will rally strongly, but rather recover gradually and slowly, and I'm very comfortable with a $60 price target. A lot of stocks in the sector rallied hard, which means that we might see some short-term pullbacks in the near term, and I encourage you to take those short-term pullbacks as a buying opportunity. Our preferred stock in the sector is Oil Search. The material sector in general, looking at the index, is still showing a strong recovery. Although overbought, I believe there is room on the upside. Looking at the material stocks, I have a strong preference to BHP, followed by Rio. And I see that Fortescue Metals is forming some sort of a double top with resistance around 520. So I encourage you to look at BHP on a pullback. The financials are also in a recovery mode, coming from a low base. There is plenty of room on the upside in the near term, and our preferred picks are Westpac, NAB, and Commonwealth Bank. And that is close to resistance, so I encourage you to start trimming positions. And Macquarie is extremely overbought and facing strong resistance, so those two are your funding ideas. Staples had a good run and now are showing some signs of weakness. So Wesfarmers is the one facing very strong resistance around $45, $46, and it's a good candidate to trim. Another commodity is gold. Gold is in a recovery mode, but we've seen a break above minor support of 1,300 yesterday. A lot of investors have been concerned, but the key support to watch is 1,200. As long as 1,200 holds, the long-term chart and outlook for gold remains constructive. And while we are not in a strong bull uptrend here, I believe in the recovery, and I'm very comfortable with an upside target of 1,430 over the long term. Copper is quiet. The Aussie dollar is in a range. The US dollar index is in a range. So not imminent breakouts here. And with all that information, mixed information that I provided you so far, where is the call to action? Well, I believe it will come as a no surprise because, as we all know, no matter what the market does, as long as we are not in a severe bear market, there are always stocks that do well, reflecting their strong corporate earnings. So our first standout and a high conviction buy recommendation today is Domino's Pizza. Why is that? The stock has been trading in a very strong trend since listing. And just looking at the 2-year chart, we see that price action is sitting very comfortably above the long-term uptrend line. Momentum indicators are very constructive, and if people are waiting for the price to pull back near previous support level, it will never get set because a strong buying emerges well above the last support, showing how strong momentum and sentiment is. So I see, zooming into the short term, I believe the latest pullback is finding support just below $70, and we are in the process of building a small base. I believe a break above minor resistance of $73.68 is imminent and will confirm that the correction is over, which will trigger another leg up, targeting $85 over the medium term. So I encourage you to buy while we are still sitting within the range and not wait for the breakout. And the second high conviction call for today is Aurora. We've seen a great presentation, and I will follow up with a chart. There is not enough data on that chart, but the last 2 years are enough to accurately make medium-term forecasts. What we've seen is very consistent uptrend. I'm comfortable with the strength and the position of the momentum indicators. Higher highs, higher lows, showing that the price action is constructive, the sentiment is positive, and I believe that the break above 320, which is the resistance for the stock, is coming. I encourage you to buy at the bottom of the trading range that formed over the past 2 months, which means that whenever you see the price trading below $3, you can very comfortably open long positions. Our medium to long-term upside price target is $3.50. Thank you.